A U.S. government shutdown happens when politics gets in the way of paying the bills. Every year, the U.S. Congress must pass funding legislation to keep government agencies running. If lawmakers in Washington, D.C. cannot agree on a budget by the deadline, which is midnight tonight, a shutdown begins. This isn't just a local political squabble. It's an event with far-reaching consequences that ripple across the entire globe. The current standoff between Republicans and Democrats means that without a last-minute deal, many government functions will grind to a halt starting tomorrow, October 1st. This creates a cloud of uncertainty that financial markets deeply dislike, sending tremors from Wall Street to London and Tokyo. The immediate effect is the furlough of hundreds of thousands of federal workers. This means they are sent home without pay. Essential services, however, continue. Air traffic controllers and airport security staff will remain on the job, but they won't receive their wages until the shutdown ends. This can lead to staff shortages and disruptions, as seen in previous shutdowns. National parks and museums will close their gates to the public. For the average American, it can mean delays and inconveniences. For the global economy, it signals a deeper problem: political dysfunction in the world's largest economy, making it appear unstable and less reliable as a global partner. This political paralysis couldn't come at a more delicate time. The global economy is already navigating a complex landscape of inflation, interest rate decisions, and geopolitical tensions. A shutdown injects a dose of pure man-made chaos into the system. Investors and business leaders who rely on predictability are now forced to factor in this new variable. The core issue is that a shutdown disrupts the normal flow of government operations and, crucially, the release of vital economic information that everyone, from small business owners to international banks, depends on to make informed decisions about the future. The timing is particularly poor, as new U.S. tariffs on goods like heavy trucks and patented drugs are scheduled to take effect on the very same day the shutdown would begin. This creates a confusing and contradictory message. On one hand, the government is imposing new economic measures. On the other, it is failing to perform its most basic function of funding itself. This juxtaposition heightens the sense of unpredictability and risk, leaving allies and trading partners wondering about the stability and direction of U.S. economic policy. It's this uncertainty that has global markets on high alert as the clock ticks down. The mere threat of a U.S. government shutdown has already sent noticeable shockwaves through global financial markets. One of the most immediate indicators is the U.S. dollar. Today, the dollar has weakened against a basket of major currencies. The dollar index, a key measure of its strength, dipped by 0.1%. Specifically, it fell 0.4% against the Japanese yen, trading at 147.98. The euro, in contrast, gained 0.1% to reach $1.1742. This shift happens because a shutdown casts doubt on the U.S. economy's short-term health, making its currency a less attractive asset for international investors who seek stability above all else. In times of uncertainty, investors often flee to what they perceive as safe havens. Gold is the classic example. Today, the precious metal briefly soared to a new record high of $3,820 per ounce. It is now on track for its largest monthly gain since the middle of 2020, rising over 10% in September alone. This surge in the price of gold reflects a flight to safety. Investors are selling off riskier assets, like stocks, and buying gold as a reliable store of value. It's a clear signal that the market is bracing for turbulence and looking for protection from the potential economic fallout of a prolonged political gridlock in the United States. Stock markets around the world have also reacted with caution. In the United States, equity futures are pointing towards a weaker opening on Wall Street. Across the Atlantic, the Pan-European Stoxx 600 index edged down by about 0.1%. In Asia, Japan's Nikkei index closed the day 0.25% lower. This cautious sentiment is a direct response to the shutdown fears. When the government of the world's leading economy is in disarray, it reduces confidence in future corporate earnings and economic growth. This prompts traders to sell shares, leading to the modest but widespread declines we are seeing across global equity markets today. However, the picture is not entirely negative, which adds another layer of complexity. Despite the immediate jitters, some parts of the market remain surprisingly optimistic about the longer-term outlook. For instance, U.S. stocks are still on course to end the month of September with a gain of over 3%. Some asset managers have even noted they are increasing their holdings in equities. This suggests that while the shutdown is a significant short-term risk, some investors believe the underlying economic recovery and expected interest rate cuts from central banks will ultimately outweigh the political drama unfolding in Washington. One of the most significant and concerning consequences of a U.S. government shutdown is the halt in the release of crucial economic data. Government agencies like the Bureau of Labor Statistics are responsible for compiling and publishing key reports on jobs, inflation, and economic growth. If these agencies close, the data simply doesn't come out. This week, for example, the market is anxiously awaiting Friday's employment report, which provides a detailed look at the health of the U.S. labor market. A shutdown would almost certainly delay its release, leaving everyone in the dark about the state of the economy. This lack of information creates a massive problem for decision-makers, especially the U.S. Federal Reserve. The Fed relies on data like the Consumer Price Index for inflation and the jobs report to guide its monetary policy, particularly its decisions on interest rates. With its next major meeting scheduled for October 29, the central bank could be forced to make critical choices without the latest facts. This is often described as flying blind. Without timely data, the Fed cannot accurately gauge whether the economy is overheating or slowing down, making its job of steering the economy exponentially more difficult and risky. The potential delay of major reports elevates the importance of any data that is released before the shutdown begins. For instance, today's JOLTS report, which measures job openings in August, has suddenly become a focal point for markets. Analysts are watching to see if the number of openings holds firm around 7.18 million. This report could be the last significant piece of labor market information that the Federal Reserve and investors see for weeks. Its findings will be scrutinized intensely for any clues about the economy's direction, carrying far more weight than it normally would. This data blackout doesn't just affect the Federal Reserve. It impacts everyone. Businesses use this information to make hiring and investment decisions. International investors use it to decide where to allocate their capital. Even everyday people are affected, as the data influences everything from mortgage rates to the price of goods in shops. A prolonged shutdown would create a vacuum of reliable information, replacing it with speculation and rumor. This uncertainty can cause businesses to pause their plans and investors to pull back, potentially slowing down economic activity and creating a self-fulfilling prophecy of economic weakness. The potential U.S. shutdown is not just an American problem, it is a global one, and different regions are reacting in their own distinct ways. In Europe, markets have responded with cautious pessimism. The STOXX 600 index, which tracks major European companies, dipped slightly as investors worried that political instability in the U.S. could disrupt trade and slow global growth. European leaders watch these events with concern, as a weaker U.S. economy means less demand for European goods and services. The firming of the euro against the dollar also makes European exports more expensive, adding another headwind for the continent's businesses. In Asia, the reaction has been more mixed. While Japan's Nikkei index fell in line with global jitters, other parts of the region showed surprising resilience. China's CSI 300 index, for instance, actually rose, marking its fifth consecutive month of gains. This divergence is partly due to local factors. China just released its latest manufacturing data, which, while still showing a contraction, was better than the previous month. This has given some investors hope that government stimulus measures are beginning to work, allowing them to look past the political noise coming from Washington for now. Australia provides another interesting case study. Today, the Reserve Bank of Australia decided to hold its key interest rate steady at 3.60%. In its statement, the central bank cited global economic uncertainty as one of the factors influencing its decision to wait and see. Following the announcement, the Australian dollar strengthened. This shows how decisions made in Washington directly influence the policy calculus of central banks on the other side of the world. A U.S. shutdown adds another layer of risk that makes other countries more cautious about their own economic paths. Ultimately, the entire world is watching Washington with a sense of apprehension. A shutdown, especially a prolonged one, would not only damage the U.S. economy but also threaten the fragile global recovery. It undermines America's reputation as a stable and predictable economic leader. For global investors, it complicates an already challenging environment. For central bankers, it makes their fight against inflation harder, And for everyday people around the world, it raises the risk of a broader economic slowdown. The hope is for a swift resolution, but as the midnight deadline approaches, the world is bracing for disruption.